Hashtag AI in Tech News, July 9, 2026. Grok 4.5 just dropped at half the price of ChatGPT, Apple's going full American with new chips, and OpenAI's launching something that'll change how you talk to AI forever. We're breaking down 7 massive stories in tech today, from SpaceX's AI bombshell to a crypto megafund, rare earth supply chaos, and a John Deere victory that could reshape an entire industry. Stick around because one of these stories is about to flip your entire tech stack upside down. SpaceXAI releases Grok 4.5, which Elon describes as an Opus-class model. Elon Musk just dropped Grok 4.5, and it's shaping up to be a serious contender in the AI arms race that's been heating up all year. The company's positioning this as an Opus-class model, which is industry speak for a heavyweight AI that can compete with the most advanced systems out there. What makes this release particularly interesting isn't just the capability bump, it's the promise of doing more with less. We're talking cheaper computational costs and better efficiency, which could fundamentally shift how businesses think about deploying AI at scale. The context here matters because we're in a critical moment where AI development has become increasingly expensive. Training these massive models requires enormous amounts of computing power, and that cost gets passed down to users. If Grok 4.5 can genuinely deliver comparable performance to other top-tier models while consuming fewer resources, that's a game-changer. It suggests that raw computational power isn't the only path forward. Smarter architecture and optimization matter just as much. This is exactly the kind of innovation that could democratize access to powerful AI tools beyond just the tech giants. The broader implications are worth thinking about carefully. We're watching a shift from bigger is always better to smarter is better. If Musk's company can prove this works at scale, it opens doors for smaller companies and startups to compete in spaces previously dominated by well-funded labs. It also puts pressure on other AI developers to optimize their models rather than just throwing more computing power at the problem. That's healthy competition, and it's exactly what the industry needs right now to avoid consolidation around a handful of megacorporations. Apple to produce made-in-America wireless chips with Broadcom. Apple just made a massive $30 billion bet that could reshape how America manufactures cutting-edge technology. The company has signed a multi-year deal with Broadcom to design and produce over 15 billion custom wireless connectivity chips right here in the United States. This isn't just another supply chain announcement, it's a fundamental shift in how one of the world's most powerful tech companies thinks about where its components come from. Here's why this matters. For decades, the semiconductor industry has been almost entirely dependent on overseas manufacturing, particularly in Taiwan and South Korea. Apple, like most tech giants, has relied on this global supply chain for everything from processors to wireless chips. But geopolitical tensions, pandemic-related disruptions, and growing pressure from Washington have forced companies to rethink this strategy. By partnering with Broadcom on domestic chip production, Apple is essentially saying that American manufacturing can compete at the highest levels of technology. These aren't simple components. Wireless connectivity chips are incredibly complex, requiring cutting-edge fabrication techniques and billions in investment. The implications ripple far beyond Apple's product lineup. This deal signals to other tech companies that onshoring isn't just possible, it's becoming necessary. It also represents a massive vote of confidence in American manufacturing capabilities at a time when the US is trying to rebuild its semiconductor industry. For consumers, this could mean more stable supply chains and potentially faster innovation cycles. For the broader tech ecosystem, it's a reminder that in an increasingly competitive world, controlling where your technology is made has become just as important as the technology itself. SpaceX's Grok 4.5 launches at half the price of rivals. Here's why that could rattle Anthropic and OpenAI. Elon Musk just dropped a bomb on the AI industry, and it's not about raw performance, it's about disruption through economics. SpaceX released Grok 4.5 this week, a coding-focused AI model priced at half what you'd pay for comparable tools from OpenAI or Anthropic. This isn't some scrappy startup undercutting the market, this is a billionaire with a vertically integrated empire deciding to wage price war on the AI establishment. The timing is particularly aggressive because Musk just acquired Cursor, a $60 billion coding startup, weeks ago, and Grok 4.5 is the first real product of that acquisition. We're watching a fundamental shift in how AI companies compete. Here's why this matters beyond the headline. For months, the AI narrative has been obsessed with benchmark scores and leaderboard rankings: who's smarter, who's faster, who can solve the hardest problems. But Musk's strategy is betting that developers actually care about something different: speed, cost, and whether the model works for real-world tasks. Grok 4.5 is purpose-built for coding and autonomous agents, which means it's optimized for what developers actually do every day. By undercutting on price while offering specialized capability, Musk is essentially saying the emperor has no clothes, that the premium pricing of competitors isn't justified by performance alone. The broader implication is that the AI market is about to get messy in the best way possible. We're moving from a world where a few companies control the narrative to one where capital, integration, and strategic focus matter as much as raw research talent. Anthropic and OpenAI built their moats on being first and being perceived as the smartest. But Musk is proving you can compete by being faster, cheaper, and more focused on what users actually need. Whether Grok 4.5 lives up to the hype remains to be seen, but the competitive landscape just fundamentally changed. OpenAI launches GPT-Live, a full-duplex voice upgrade that lets ChatGPT talk more like a person. OpenAI just made your ChatGPT conversations feel like talking to an actual person, and this is a bigger deal than you might think. They've launched GPT-Live, a new voice system that can listen and speak at the same time, ditching the old back and forth where you'd finish talking, wait for the AI to respond, then talk again. It's full-duplex audio, which means real-time, natural conversation. The rollout started today across phones and the web, with two versions, GPT-Live 1 for paying subscribers and a lighter mini version for free users. This isn't just a polish on existing tech, it's a fundamental redesign of how humans interact with AI. Why does this matter? Because voice is becoming the primary interface for AI, especially on mobile. For years, companies have been chasing this holy grail of seamless voice interaction, and the technical barrier has always been latency and the ability to interrupt naturally. With simultaneous listening and speaking, you can now interrupt ChatGPT mid-sentence, ask follow-ups without waiting, or have it jump in when you pause. That mirrors how humans actually communicate, which makes the experience feel less robotic and more collaborative. OpenAI is betting that this naturalness will drive adoption across their user base, and frankly, they're probably right. The broader implication here is that we're watching AI assistants transition from tools you use to companions you converse with. This technology will likely spread across the industry, competitors will scramble to match it, and suddenly every voice assistant will feel outdated. We're also seeing OpenAI double down on making AI accessible to everyone, from free users to pro subscribers, which suggests they're thinking long-term about market dominance. The real question isn't whether this works technically, it clearly does, but how this changes the way we work, learn, and think when AI can talk to us like a real person. Crypto VC firm Paradigm raises $1.2 billion to invest in technical frontier startups. A major crypto venture capital firm just secured $1.2 billion to bet on the next generation of deep tech companies, and this move signals something bigger than just another funding round. Paradigm, one of the most influential investors in blockchain and cryptocurrency, is making a deliberate pivot that tells us exactly where the smart money thinks the real opportunities are heading. They're not abandoning crypto, but they're explicitly expanding into robotics and artificial intelligence, which means they're betting that the technical frontier of the next decade won't be confined to one industry. Here's why this matters for context. Paradigm has built its reputation by backing some of the most important crypto infrastructure projects from the ground up. They understand how to identify technical breakthroughs before they become mainstream. Now they're applying that same thesis to AI and robotics, two fields that are experiencing exponential progress but are still in relatively early stages compared to where they'll be in 5 to 10 years. A $1.2 billion fund isn't just money, it's a statement that these founders believe the convergence of AI, robotics, and potentially blockchain technology represents the genuine technical frontier worth betting on. The broader implication here is that we're entering a phase where the most sophisticated investors are treating AI and robotics as infrastructure plays, not hype. This isn't about chatbots or consumer gadgets. This is about backing the fundamental technologies that will power everything else. When a firm with Paradigm's track record in capital commits this much firepower to these sectors, it typically means we're going to see accelerated development, more ambitious startups getting funded, and ultimately faster innovation cycles. The next few years of AI and robotics breakthroughs might move even faster than we expected, and this fund is positioning itself right at the center of that wave. U.S. rare earths flow to Asia as domestic demand is slow to emerge. Here's a story that exposes a massive crack in America's tech independence strategy, and it's happening right under the nose of the administration that promised to fix it. U.S. rare earth miners, many of them directly supported by government backing and Trump administration policies, are shipping their materials to Japan and South Korea instead of building out domestic supply chains. This isn't just a trade story, it's a fundamental failure of industrial policy that could cripple America's AI and semiconductor ambitions for years to come. Let me explain why this matters. Rare earth elements are the backbone of modern technology. They're essential for everything from smartphone displays to advanced semiconductors to the chips powering AI data centers. For decades, America outsourced this entire industry to China, creating a dangerous dependency. The administration recognized this vulnerability and started backing domestic mining operations with the explicit goal of building American supply chains. But here's the problem, there's no actual domestic demand yet. American chip manufacturers and tech companies haven't committed to buying American rare earths at scale, so miners are doing what makes economic sense, they're selling to Japanese and South Korean buyers who have established relationships and guaranteed contracts. This creates a vicious cycle. Without domestic demand, American miners can't scale up production efficiently. Without scaled production, prices stay high and supply remains unreliable. Meanwhile, our competitors in Asia are securing long-term access to these critical materials while American companies continue to rely on imports. The irony is brutal, we're funding the mining, but we're not funding the actual infrastructure and commitments needed to make it work. This isn't just about economics, it's about whether America can actually execute on its tech independence goals or if we're just going through the motions. The broader implication is clear. AI and semiconductor leadership requires complete supply chain control, and right now we're failing at the most fundamental level. If we can't even get rare earths flowing through American hands, how are we supposed to compete with China's vertically integrated tech ecosystem or maintain an edge over Asia's coordinated industrial strategy? This story should be a wake-up call that policy alone isn't enough. We need actual market mechanisms and corporate commitments to make American tech independence real. The FTC settlement with John Deere is a huge win for the right to repair movement. Hashtag the FTC just handed farmers a massive victory against corporate control. After over a decade of fighting, farmers have finally broken through John Deere's iron grip on equipment repair. The FTC settlement announced today is a watershed moment that goes way beyond tractors and combines. This is about who actually owns the technology you buy, and it's sending shockwaves through an entire industry built on locking customers into proprietary ecosystems. Here's what went down. John Deere had essentially turned modern farming equipment into a walled garden. Farmers couldn't repair their own tractors without paying premium service fees to authorized dealers, and independent repair shops were completely shut out. The company used software locks and proprietary parts to maintain total control over the repair market. For agricultural workers operating on razor-thin margins, this wasn't just inconvenient, it was economically devastating. The FTC finally said enough, and now farmers get access to repair manuals, diagnostic tools, and the ability to fix their own equipment. But here's why this matters beyond the farm. This settlement exposes a critical flaw in how we've let tech companies operate. We've normalized the idea that companies can sell you something but retain complete control over how you use it. That model has infected everything from smartphones to cars to medical devices. The precedent being set here, that consumers have fundamental rights to repair what they own, directly challenges the artificial scarcity business model that's become standard in tech. The broader implications are enormous. If this principle holds, we could see similar pressure on other industries that have built empires on repair monopolies. This isn't just about fairness, it's about breaking the cycle where companies use software and legal restrictions to create endless revenue streams from captive customers. The FTC just proved that movement has teeth, and corporate America is paying attention. Thanks for staying updated with Neural Brief. Hit subscribe and ring that bell so you never miss tomorrow's biggest tech stories. See you tomorrow.